Welcome to the Techno Fundamental Report for August the 14th. Look, we all know our country has too much debt. But under Scott Bessent's leadership, we could possibly grow ourselves out of this. Now, it may take a generation to do it, but he has something called the 3-3-3 policy. Cut budget deficit to 3% of GDP by 28. That's going to be a challenge. Spur 3% GDP growth with deregulation. Again, we're running at about 1.5%. We're under 2%, but he's saying that we could get the GDP growth rate up, which will help produce an additional 3 million barrels of oil a day. So that's his 3-3-3 policy, and you can see the problem that we need to solve. I don't see any way out of this other than to grow our way out of it. I just don't see it. Data center versus office construction. So here's the launch of GPT, and you can see what's been happening. They're building these data centers. There's about 15 of them right now. One in North Louisiana that's supposedly the biggest in the Western Hemisphere. But you can see what's happening with office construction. So basically, I think what this means is people are going to be able to use AI to pretty much work out of their homes and not have to go to offices or smaller offices. All price changes are caused by imbalance in supply and demand. A stock is not the same as the company. So let's think about the auction process. Let's say you have a prize bull. And in recent auctions, your bull would have sold for $10,000, let's say, just hypothetical. Well, if the sellers outnumber the buyers, that's going to be a problem. And also, let's say 10 other bulls show up that day that are all of equal quality, which is competition, to the auction house that day. So what I'm saying is that the stock is not the company. This bull is the same bull. It's just the fact that he's being sold in an auction market where supply and demand come into factor. So this is just something very important to get your head around because, you may think you know a lot about the company and everything's great, but price matters. The price matters. And the price is going to be determined by the supply and demand of buyers and sellers for that particular security, just like the numbers of buyers and sellers for the prize bull. It's the same concept. Now, I want to talk a little bit. I went to my dentist the other day, and he was just telling me all about the stock market and how much he knew about it. He's a pretty smart guy. But what I tell people is you got to get really, really serious about this. You can't be in there fixing people's teeth while the market's open. Now, I know a lot of people don't really like this concept, but if you go back and look at the most successful investors in history, Bernard Baruch, Jesse Livermore, Richard Wyckoff, these guys were tape readers. They would basically, now I use technical analysis by using charts and just prices that I can get published, but back in the old days, the only way you could get price and volume data was from the ticker tape. So these guys spent their days, all day while the market was open, watching that ticker tape. They were very serious about what they were doing. So good luck to my dentist. Hope he does well. He'll probably do just fine. But I'm saying you have to be serious about this. This requires a lot of work. The Great Depression could have been avoided if the Fed had not so badly botched its monetary policy. This is Milton Friedman's theory, and it's called the Great Depression myth. So the more I think about the Federal Reserve, it just seems like they cause more problems than benefits. It was because of their actions, according to Milton Friedman, because of their actions in 1929, which was to restrict the money supply, it caused massive bank failures, and they kind of blew it. So I think we really need to as Americans, we need to take another look at this institution. Now, if you're going to get serious, like I was talking about with these guys, okay, you got to get serious. You have to be on top of this. You have to be on top of your game. So when someone comes to me and says, I want to invest in the stock market, I'll say, look, you got to get serious about this. And the first thing you got to do is you got to start reading some books. And you know what? I don't think anybody ever reads them. I don't know why that is, but like the main book I recommend is Nicholas Darvis's book, written in 1956. It's how he made $2 million in 1956. Well, he actually started in the 1940s. But this is a short read. I mean, it's like a weekend read, but it's so interesting. It's written like a novel. Then take this book about Sam Walton. I've read this book years ago, but I'm going to reread it. He was just a nice man, and his employees worshipped him. Now, Steve Jobs, another story. He was a tough cookie, but he was smart, and he was very technologically savvy. A Man for All Markets. I haven't read it yet. Plan to put it on my reading list. Same for this one here about Paul Volcker, Keeping at It. Now, this is the most important book you can read. This is William O'Neill, and he talks about his system that he developed where he did a 100-year study, and it was very interesting, his results. Peter Lynch, he was real big on things like Walmart, where you go in and count the cars in the parking lot, and you only want to invest in things that you understand and know. There's a lot of truth to that. Elon Musk, been in the news a lot lately, but this is a very good book by Walter Isaacson. Jesse Livermore. Walter Deemer's book, you can read it in like an afternoon. It's just a bunch of quotes that he talks about, and I find his quotes very interesting, and it's a very kind of a lighthearted, easy book to read. The Quants, haven't read it yet. It's on my reading list. So is this book as well. So I'm just recommending, if you're going to get serious about this, you really ought to read some books. So look, let's take a look at the markets right now. There's some interesting stuff going on here. Now, this is what we call the tides. Tides come in, tides go out. And so when you've got a reading like this, the tides are out. But when you've got a reading like this, the tides are in. Now, what you want is for the NASDAQ to be trading above the lower moving average, which it's doing. Now, we're going to look at 5 indexes. We recommend you look at 5 indexes. Don't just look at the Dow Jones Industrial Average. It's 30 industrial cyclical companies, and it really doesn't actually represent things as much as you need to have them. Now, here's what we're seeing. We're seeing some definite changes here in character of the market. This is the mid-cap stocks. You can see here, first time breakout. I mean, this is a major breakout here. Now, will it last? I don't know. But if you start to see where we're seeing is the market is broadening out. It's not just 7 technology stocks. Here's the New York Stock Exchange. Same thing. You're getting a breakout here. Very positive. That's been a sleeper. Now, here's the big one. This is the small caps. We have not seen the small caps break out like this in quite a while. Now, small caps tend to be very interest rate sensitive, so this might be discounting the fact that the Fed is going to cut interest rates. Here's the S&P 500. Again, you can see the uptrend. Everything's fine. Now, one more thing here. We are in what we call a power trend. Power trend really got started kind of back here when we got the 50-day moving average turning up. But the power trend only will end if the 21-day moving average crosses below the 50-day. So we are in a very powerful uptrend here. Don't underestimate it. Now, let's see. I also have, okay, that was just on the NASDAQ. All right, here we have the aggression index. It's hitting new highs. I mean, it's basically saying that growth stocks are outperforming value stocks, which are things like Heinz ketchup, that kind of thing. Dead companies that really don't have anything going on, whereas this is where all the excitement is, but it's also where the risk is. So we take the risk divided by defensive. If the line is going up, it's saying that this is a healthy market. Now, I wanted to mention interest rates. Interest rates are really starting to come down here. This is great news. And if you see our power index here, it's saying that for the last 125 trading days, interest rates on the 5-year Treasury have dropped roughly 16%. That's a lot. So we're starting to see really a downtrend developing here in interest rates. This indicator is designed to try to forecast what the Fed's going to be doing. Okay, last but not least, I wanted to mention the volatility index. It's hitting a fresh low here. This is a very positive sign, and it usually goes along with bull markets. So whether it's a bull market or an up market or whatever you want to call it, we like what we're seeing right now. If you have any questions, please let me know.